Hello, and welcome to this week's edition of WTF is Going On with the Economy, your weekly guide to market and economic news for those living and working abroad. This past week, financial markets took a hit as stock indices tumbled, bond yields fluctuated, and currency markets saw major shifts. In the US, the S&P 500 fell 1.36% following President Donald Trump's announcement of new tariffs on imports from Canada, Mexico, and China, stoking fears of a prolonged trade war. Over in Europe, the stock 600 dropped 1.74% as investors reacted to the European Central Bank's decision to cut interest rates by 0.25 percentage points to 2.5%, a move signaling concerns over the Eurozone's sluggish growth. Meanwhile, in the UK, the FTSE 100 fell 2.16%, driven by economic worries, a strengthening pound, and continued uncertainty over post-Brexit trade agreements. In the bond markets, European and U.S. government bonds also took a hit. The Bloomberg 10-plus-year Euro government bond index dropped 1.34% as investors adjusted their portfolios in response to shifting monetary policies and economic forecasts. Similarly, the U.S. 10-year Treasury declined 1.32%, reflecting ongoing inflation concerns and uncertainty about future interest rate hikes. With the Federal Reserve still weighing its next move, investors have turned to the bond market for safety, driving bond prices up and yields down. The currency markets weren't spared from volatility either. The U.S. dollar weakened significantly, with the USD to euro exchange rate falling 3.25% as markets reacted to expectations of slower U.S. economic growth and a more dovish Federal Reserve. Meanwhile, the euro gained strength following Germany's major policy shift. The British pound also weakened against the euro, falling 1.58% amid concerns over the UK's economic trajectory. Against the dollar, the pound remained under pressure, reflecting traders' reactions to weaker U.S. economic data and shifting expectations around interest rate policies. The past week wasn't just about market swings, it was shaped by major economic events that are likely to have long-term implications. The European Central Bank cut rates on March 6th, lowering its benchmark interest rate to 2.5%, marking its sixth rate cut in 9 months. This move was driven by concerns over slowing economic growth in the Eurozone, easing inflation, and heightened uncertainty from trade conflicts. ECB President Christine Lagarde acknowledged that while inflation is stabilizing around the 2% target, trade wars and security risks continue to pose significant threats to Europe's economy. Meanwhile, Trump's tariff war escalated before hitting pause when he delivered his first address to Congress since his re-election, announcing a 25% tariff on imports from Mexico and Canada and a doubling of tariffs on Chinese goods to 20%. His justification was fighting the fentanyl crisis and unfair trade practices, but the move sparked backlash from U.S. businesses, who warned of supply chain disruptions and higher consumer prices. In response to criticism, Trump delayed the implementation of the Canadian and Mexican tariffs until April 2nd, giving companies time to adjust. However, the most surprising economic shift of the week came from Germany, which dismantled its debt brake rule, a fiscal policy that had limited how much the government could borrow. For years, Germany maintained strict fiscal discipline, but new Chancellor Friedrich Merz announced that the country will remove borrowing limits on defense spending and hinted at scrapping the broader debt brake. This marks a historic policy shift, with massive implications for Germany, Europe, and the global economy. Looking ahead, several key economic events will shape market movements this week. On Monday, March 10th, Eurozone finance ministers will convene for the Eurogroup meetings, where they will discuss economic policies and financial stability within the region. These discussions will be closely watched for any signs of further fiscal stimulus or economic restructuring plans following Germany's policy shift. On Wednesday, March 12th, the U.S. Consumer Price Index for February will be released, providing a crucial look at inflation trends. If inflation comes in higher than expected, it could push the Federal Reserve to delay interest rate cuts, which could further impact bond yields and equity markets. Lastly, on Friday, March 14th, the United Kingdom will release its gross domestic product figures, offering a fresh look at the country's economic growth rate. This will be particularly important for investors assessing how well the UK economy is performing amid global uncertainties and ongoing post-Brexit trade negotiations. An asset we are watching from these changes is bonds, particularly German bunds, aka German government debt. Initially, bond yields fell following the ECB's rate cut as investors flocked to safe haven assets, but that changed drastically once Germany announced its massive fiscal shift. The 10-year Bund yield skyrocketed by over 40 basis points, reaching 2.90%, one of the biggest weekly sell-offs since the 1990s. The reason behind this spike is that Germany's plans to spend big, including a €500 billion infrastructure fund and relaxed borrowing rules, mean the government will need to issue more bonds to finance its spending. This increased supply of bonds is pushing yields higher, as investors demand higher returns to lend money to the government. The ripple effects were felt beyond Germany, as bond yields serve as the benchmark for European interest rates, meaning their rise could drive up borrowing costs across the continent. Investors are now closely watching how Germany's fiscal shift plays out, and whether it inspires similar policy changes in other European countries. These developments highlight just how interconnected the global economy is. Germany's fiscal shift, U.S. trade policies, and central bank decisions are rippling through markets, affecting currencies, investment flows, and economic growth worldwide. A stronger euro impacts global trade competitiveness, shifting capital away from the U.S. dollar. Meanwhile, higher German bond yields could raise borrowing costs across Europe, shaping corporate and government financing strategies. And with uncertainty from tariffs and inflation concerns looming, investors remain on edge, watching how these shifts will impact corporate profits and consumer prices in the months ahead. Time for the term of the week. This week's term is yield, and if you've been following the bond market swings, you've probably seen the term yield thrown around a lot. In financial markets, yield refers to the return an investor earns on a bond, typically expressed as an annual percentage. It represents income generated from the investment, mainly through interest payments, coupon payments, in relation to the bond's price. One key concept in bonds is the inverse relationship between prices and yields. When bond prices rise, yields fall, and when bond prices fall, yields rise. For example, if a €1,000 government bond pays a fixed annual coupon of €30, 3%, but its price rises to €1,100, the yield falls because the same €30 payment is now a smaller percentage of the higher price. On the other hand, if the bond's price drops to €900, the yield increases because the fixed €30 payment is now a larger percentage of the lower price. Interest rates, inflation expectations, and investor sentiment all influence bond yields. Higher interest rates push yields up, while economic uncertainty often causes investors to buy bonds, pushing prices up and yields down. This week's wild ride in bond yields is a perfect example of how bond markets react to policy shifts. That's it for this week's update. Thanks for tuning in, and we'll see you next time. Note: the information in this bulletin is for informational and educational purposes only and does not constitute financial advice.